Hello and welcome to Indianomics. It's a jubilant Indianomics. It's a stunning growth number that we are looking at. India's first quarter GDP growth has come in far higher than expected at 7.8%. The CNBC-TV18 poll indicated an expectation of just 6.8%, and we were still higher than many people on the street. The contribution from government expenses, both capex and revenue expenses, and the services sector is particularly impressive. Let's decode the numbers with our experts. I'm joined by Radhika Rao, the senior economist from DBS Bank, Sakshi Gupta from HDFC Bank, all senior economists, Kanika Pasricha of Union Bank, and Aditi Nair, the chief economist at ICRA. Ladies, what a pleasure that all of us are going to discuss an extremely encouraging and optimistic number that we have. Just a word to our viewers before I come to you. The 7.8% number sometimes gets overstated because there is indirect taxes. You know, very low subsidies and very high indirect taxes compared to the base year makes the GDP look very good. No such tomfoolery over here. The GVA, which is net of the taxes, is also very high at 7.6%. It's a 6-quarter high. The GDP is a 5-quarter high. So, you know, it's abashedly and unadulterated a good number. The other argument we normally have is that nominal GDP at 8.8 is not all that high. It's because inflation is very low. So you are deflating the nominal GDP by a very small 1%. WPI being negative for 2 months has led to the GDP looking very good. Even that argument doesn't wash because from the poll I got, even the nominal GDP came in only at 8%, whereas the actual number is 8.8. So the data has outshone what economists were expecting on every parameter. This is a damn good number. I was expecting that economists will have to revise their forecast lower after they see the first quarter. Now they will revise their number, but mostly higher. Likewise, the RBI, we thought, will be forced to bring down its GDP forecast. It stands at 6.5%, higher than the rest of the market. Now it will probably revise it higher. But let me, with that preface, get to our experts. Sakshi, you go first. What surprised you, and will you be revising your numbers?
Right, Lata, I think at the headline level, of course, this number is very, very surprising for all of us. You know, you already spoke about the fact that this growth is being underpinned by a strong services sector growth. You know, but let me just point out that, you know, the deflator for services is in fact very, very low for Q1. It's just about 1.9, which is much lower than what we have seen over the last, I think, 5 to 6 quarters. Be that as it may, I think the biggest surprise for me actually in this data was, you know, 2 numbers. One was agriculture growth, which in my opinion is much lower than what we were anticipating, especially given the fact how, you know, the Rabi crop performed, also that this number is coming on a very low base. So I think 3.7 to me seemed like a, you know, low number. On the other hand, I think the manufacturing growth number, you know, that we have in this data is 7.7. Which is significantly higher than what we were estimating. And I think it doesn't completely align with, you know, some of the high frequency indicators that, you know, we had tracked for Q1, for instance, you know, IIP growth. You know, we must remember that, you know, a caveat that we must remember that, you know, quarterly numbers are prone to revisions going forward. Be that as it may, you are right that this number does show that economic activity held up in the first quarter. But the problem is that, you know, I think the pain from things like tariffs are yet to be seen, and that was very much expected even before this number came out, right? So my estimate for the year, I mean, I'm keeping it unchanged for now at 6.3. I think that we have to wait and watch how some of the impact of the 50% tariffs is going to start playing out in the second quarter, and I think consequently the numbers that we see are going to be lower.
Okay, fair point. Actually, exactly the same number surprised me as well. My average for agriculture came in at 5.8%. So this 3.7% is a surprise even versus our poll. Likewise, manufacturing for us had come in at 5.3%. Here at close to 8%, that also is a surprise. So clearly, the numbers have surprised not just you, but all the respondents whom we polled. for the CNBC-TV18 poll. Aditi Nair, if you can look at the GDP from the expenditure side, personal consumption 7%, government consumption 7.4%, and capital formation 7.8%. Any surprises there?
Thank you, Lata. So certainly as far as the expenditure side is concerned, with the investment indicators, particularly government capital expenditure having grown very sharply on a small election curtailed base, we were expecting that GFCF will post a very healthy growth. So no surprises there. And a similar argument for the government part of consumption, expenditure, and overall government spending. I think I'm just a little bit surprised. If we look at the last 5-6 quarters of the private final consumption expenditure data, the growth all ranges between 6 to 8%. And here, I mean, quarter after quarter, we've been lamenting about the state of consumption, clutching at straws that rural consumption is doing a little better, urban is uneven, it's only being driven by the high income households. And we have a 7% consumption growth for the private final consumption expenditure in this quarter. So I think, like what Sakshi said, if we look at the sectoral side and compare it with the high frequencies we had and compared with the kind of earnings we've seen, there is a discrepancy. Similarly, within the expenditure side, it's not really gelling with the kind of commentary we keep hearing and the narrative we keep discussing on the consumption side. And discrepancies, again, I think have turned around. There's a large increase in discrepancies between Q1 of FY25 and Q1 of FY26. So that will also have some impact on the underlying expenditure side aggregates. So overall, I would say I totally agree with Sakshi. This number has come in much better than what we expected. But the pain entirely lies ahead.
No, I take your point that, the number has come in higher than expected, and it is not gelling with some of the high frequency numbers that we see on a daily basis. FMCG companies, complaining that they don't see too much consumption. I mean, we see it all over the place. And therefore, the number does surprise us that both consumption and capital goods have come in good. Kanika, the export number, I thought, that one of the reasons why GDP would do well would be that people will advance book exports. But it's only up 6.3%. So it looks like we may, in the second quarter, for July, August, also see a very good export number because it doesn't seem to be pre-booked over here.
So you're right, Lata. Maybe, the number for July and August in terms of exports may throw up some positive surprises. But see, Lata, what is very important is, yes, exports growth. While we all said that the reason, so we were at 7% for this quarter, while the consensus was 6.7. And one of the reasons we were at 7% is the theme, the underlying fundamental framework was that everything is front-loaded in this quarter. Exports, US didn't slip into a recession, global demand has not slowed as much as feared. And of course, it's front-loading ahead of tariffs. Apart from the favorable base effect because of election quarter, same period last year. But very important point to note is, while exports growth is looking relatively tamed, your imports growth is also held up. So we were looking at percentage point contribution of net exports to GDP. In the last quarter, of course, it was a surplus. So it was plus 2, plus 3% percentage point contribution. In this quarter, it becomes a negative. -1, -2. So there's a switch over as well, which is also weighing on overall growth dynamics. So while we thought exports front loading may help in this quarter, it has not happened. Maybe some impact will be seen in the second quarter, though I would still say September may be a washout. The kind of scary stories we are hearing from the MSME exporters is not so positive to take back home. But very important, in our view, this number is not due to front loading of exports. The surprise is coming from consumption, as both Sakshi and Aditi pointed out, which is why trade is up 8.5%. Very important. And private consumption is up around from 6% to 7% March to June. That's one. Second, even real estate and financial services have done well. That number at 9.5% is also a very positive surprise, apart from, of course, manufacturing. Thanks.
No, absolutely. That was precisely my point. I would have thought exports would have been very good. but it's a very pale 6.3%, which means something else has fired up since the overall number also is above everyone's expectation. And it is not even because of exports, which means domestic consumption and domestic capital formation has done so well, so much better than the general expectation. Radhika, from your perch, do you think now the global view of India will change? It may perhaps be able to weather the tariff storm better.
Hi, Lata. Certainly, I think this number does come. I think it's more than 1% higher than where the market consensus was, heading into this data. So it does show that even as a starting point, growth was at a much stronger level. And what you've seen is that, you spoke about deflators earlier on, and that is a bit of a technicality because an industry breakdown, deflators don't impact as much as services does. So services does is adjusted for deflators because you're getting from volume to value. So from that point of view, there is a bit of a technical push to the headline, but certainly anything above 7% in an environment where dark clouds are gathering, so to speak, is a very strong starting point. Now, looking at some of the breakdown as well, I think you spoke about trade briefly. And what we are seeing in the region as well as in India's case is that growth exports to the US, for example, have done very well. There's a lot of signs of front loading there. But if you see rest of the world, you don't necessarily see that bump up. And that could be one of the reasons why overall exports, you really don't see that amount of pickup. And coming to the other growth drivers, certainly domestic anchor remains very, very important. I think the global environment, global trade, that's going to get a lot tougher. But I think insofar as consumption holds up, investment by the government spending point of view holds up, that works very well. And I think the other bit on services, we look quite closely at the trade and that breakdown, and that which is labor intensive, that has also grown by upwards of 8%. So certainly a lot of positives in this outcome. And I think, but when you look at the rest of the year, there's going to be two-way forces. There are still positives by way of the GST rationalizations that's coming up. And rate cuts hopefully transmission as well. But on the other side, you're going to see the impact of the tariff, I think, which will be more obvious in the second half of the year. I think there's one more quarter where we could see decent, growth and not really affected by tariffs as yet, because this was a late August phenomenon.
Absolutely. And we have a very low base for the second quarter. So I wouldn't be surprised with another 7% plus number going by the momentum that the economy seems to have shown in the first quarter, which has taken everyone by surprise. You touched about rates and taxes. Now will not the Reserve Bank ask itself, why do you need a rate cut for a 7.8% growth economy? Aditi, first to you, Sakshi, you think we should give up rate cut hopes?
I think even before this number, the possibility of further rate cuts from the RBI, given the last meeting, I think were very low. Right. I think that, people were talking about perhaps another 25 basis points if there are, very big downside surprises to growth. So, that is one thing. The second thing is, I think that from a monetary policy perspective, I think what is now more important is what happens to activity from here on. Right? Because Q1 is something that has already happened. Yeah. I think that's backward looking, but monetary policy needs to be forward looking. And if we are going into this year with 50% tariffs, I think one can argue that if the impact of that and the second round impact of that is high, from an investment perspective or from a labor market perspective, there is still space for the central bank to kind of look at rate cuts. But I think that's a question that we only able to answer, by the end of next month, once we have better understanding of what's happening to MSMEs or exporters.
Fair point. Since all of you are talking about the second half likely to be, impacted, let me first get your idea of how you'll see your full year numbers changing after this first quarter number. And then we will come to the other internals of the GDP. Let me start with you, Sakshi. What will your final number be? You remain at 6.3?
Yes, so we are at 6.3. Before this number, we saw a downside risk to our number of about 30 to 40 basis points. But now with this number, I think for now, I'm keeping it unchanged.
Okay. Aditi, your old number and what may be your new number? Full year GDP?
So Lata, I was at 6%, and I'm going to argue that I'm going to stay at 6%, and I'll tell you why. A lot of the early numbers for July aren't looking that great. So Q1 is done and dusted. Exactly what Sakshi said. Let's not look behind to the momentum from Q1. Government capex from Government of India has contracted in July. That's the number we just got about half an hour, 45 minutes back. With the heavy rainfall, mining and electricity are not likely to give us any support in Q2 either. And with the very heavy rains we've seen recently, in fact, agricultural output, I mean, this is a little bit of a negative. I am surprised that the Q1 number is so low for agriculture, but the last few weeks of the monsoon turnout are not that positive for agriculture in the immediate term either, although heavy rainfall and healthy reservoir levels obviously are very good for H2 for the Rabi crop. So I think, it's my 6% forecast for the full year still requires the economy to grow by 5.5% in the last 3 quarters. And in a scenario of 50% tariffs, that's still a tall ask. So I am not increasing my forecast up from 6%. I'm keeping it over there.
Yeah, but it's important that in spite of the tariffs, it's not going below 6%, which was a fear. Kanika, old and new number. A little quickly, because I have to cover other questions. What are your forecasts?
So Lata, acknowledging 6.3%, that's what I forecast. If I keep all other numbers for the quarters unchanged, you actually move up to 6.5, 6.6. I'll still keep it unchanged because of the tariff uncertainty.
Okay. So 6.3 is your number. I'm sorry, I'm rushing you. Your new number is, your remains at 6.3.
Yes, thanks.
Right? Radhika, what were you expecting and what are you likely to change it to?
I think my number was at 6.3%. I would have an upward bias to that number. I think because otherwise we need the second half of the year to, optically and technically to be much, much weaker, though there is going to be impact from tariffs and, the other cyclical factors as well. I would lend a bit of an upside surprise to my forecast.
Okay, absolutely. Because, if the current quarter has a base of only 5.6%, so I would expect that this quarter also will show a decent number. Also, if exports are front-loaded to the United States, then, I don't know if the remaining 2 quarters should be as bad as 5%, that we should get an average so low. Let's see what the Reserve Bank says on September 30th. Now let me come to the tax part. Aditi Nair, you were the one who pointed out to me that although the February budget said that the nominal GDP has to grow by 10.1%, because we saw a bump up in last year's nominal GDP, now the asking rate is only 8%. Nominal GDP, and we have delivered 8.8 in the first quarter. So do you think now taxes and other numbers, fiscal deficit issue should not be a problem?
So Lata, I'll just kind of give you my little fiscal summary based on the July numbers that we've seen today. I'm still not worried on the nominal GDP side, like what I had said earlier, because the FY25 base got bumped up.
We may over-deliver is my point.
Yeah.
It may do better than what we thought.
Right. So otherwise, we think that the government has leeway of about 50,000 crore to either, absorb lower taxes from GST or from direct taxes, or to provide higher capex, or to provide some sort of package for exporters. So 50,000 crore is the total leeway that we see in the budget as compared to the budget estimates to take care of any of these 4 eventualities. I would rather see some sort of fiscal package for exporters than a rate cut. Given the overall growth inflation forward-looking numbers that we think will turn out to be the case.
Okay. Radhika, would you say that now even a consumption boost is not even needed? That where the GST Council meets, they can actually trim down the kind of consumption boost they need to give. The economy is not at all in a bad shape.
Certainly, I think, but we should also remember that one of the points we spoke about was the kind of gap between what high-frequency numbers look like and what the headline GDP seems to suggest. And I think no one other than states will feel that on the ground. We should remember states are facing 2 other factors. One is this GST rationalization, which I think they will probably have a bigger say when their council meets. And the other one is the tariffs. Now, tariffs, what kind of support to give businesses? While the center government will provide some support, I think states will have to lend their hand, because end of the day, they are the ones who are dealing with the manufacturing firms. We spoke about Tirupur briefly. So that is another one of the examples of textile manufacturers, So they are the ones also on the ground who need to be providing support.
Yep.
They have the bandwidth to provide that support. At this point, not many states have that, especially the ones that collect a lot more GST.
Yep.
So I think while it makes it easier going into the GST Council, but I think there will be a big pushback in terms of timeline for this, because again there are multiple other headwinds that the states are facing as well. But at the headline level, of course, the growth, like we already discussed, it looks very, very, very strong.
Yeah, point taken. Actually, we are out of time, but that's a great point to end this conversation. That the fiscal push is needed for exporters, especially in affected areas like Tirupur or the gems and jewelry area of Surat. Radhika Rao, Sakshi Gupta, Kanika Pasricha and Aditi Nair, thank you very much for joining me in this conversation. The takeaway from this is that the nominal GDP at 8.8 is also much higher than what the asking rate is, and therefore we may have a larger nominal GDP at the end of the year, in which case the government may be able to manage a higher fiscal deficit number. It was supposed to be 15.9 lakh crore. They can probably go up to 17 lakh crore and still remain at 4.4% of the GDP. That may give them some elbow room actually to design a fiscal package for the exports, export sector that is faced with the tariffs from the United States. All told, it's an excellent number. The one thing that it takes home is that it reduces chances of a rate cut from the Reserve Bank on September 30th, and it also reduces some kind of pessimism about the economy. It seems to be doing well, but we don't know whether to believe the lead indicators that we see or this GDP number, but this is for the moment an excellent GDP number. On that note, we wrap up on this edition of Indianomics. More news and updates are lined up for you.